This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Mike back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Mike's picture saying, looking for the downloads. Okay, Eric, let's get your thoughts on these equity markets.
Well, Patrick, this has played out pretty much exactly how we predicted it would here on MacroVoices 3 weeks ago. After the first big wave down, I said to expect a relief rally back up to the 200-day moving average, then most likely a failure at that level, and if so, another wave down to a new lower low. Well, we got the relief rally back up to the 200-day. It failed there just as we predicted that it likely would. Fell right back down, not quite to a new lower low. It almost retested that March 12 low. Started to bounce, actually looked like a pretty healthy bounce, but it was President Trump's tariff announcement on Wednesday afternoon that served as the catalyst to take us way back down to a new lower low. And then on Wednesday evening's futures reopen, we saw a gap down to an even lower low. As far as what happens next, though, Patrick and I have not seen Thursday's market action when the markets are open. And what happens in the overnight session when in thin liquidity really isn't all that indicative. Do we see a big downside acceleration as everybody says, oh my gosh, this is much more serious than we thought? Or does the market look through this and say, wait a minute, the president is probably just trying to force all of these countries to the negotiating table. Maybe these tariffs that were just announced won't last all that long. I think it's probably which way the market responds to that question that's likely to decide what's going to happen on Thursday. You listeners have probably already found that out by now, but as we're recording before the market opens, we're still just holding around the levels that we're seeing overnight as the market's trying to decide what to make of the Trump announcement. But as far as the technical signals that we're seeing in this market, the gap down that we saw Wednesday night into Thursday morning, well, that wasn't a new closing low at a new lower low level. It was just an intraday so far. But assuming that we get a closing print below the March 12th low, that's going to be the confirmation signal that we're probably still headed considerably lower from here. The measured move target is around 5,200 on the June S&P futures contract, but it could take several weeks to get there. And as Lynn Alden said, this is a headline-driven market. So new news could still change everything. We could be, back at new all-time highs next week. But as far as what I'm seeing in the technicals right now, looks to me like we're headed lower.
Eric, I agree with the 5,200 downside target as a measured move. That is a logical place for this to go. So I just want to touch on the charts that we featured last week. We looked at the market tops of 2022 before the bond bear market. The S&P had that big correction. The 2018 market top before the Christmas massacre. And I just also took the last major bear market and took the top of 2007. And one of the things that we highlighted was that these bear market rallies occur all the time. And we were following the analog as to whether the market bounce we saw over the last week was in fact just a bear market rally. And if it was, how long would it last and when would it roll over and potentially turn? And so when we look at today's market on page 5, we can see that we had about 11% market drop with a 6% market bounce. And it found that 50-day moving average, rejected that 200-day that you were talking about. And now we've rolled over and we are slowly creeping to lower lows. And the question now is, what's next? And typically, these markets make moves in symmetry. And so with the fact that the prior sell-offs, if we use those examples that we did in the prior pages, it is very logical to anticipate a move down towards 5,000. And so now what would happen if we saw that kind of a market drop? Well, we would see one of the things I'm watching for is, will we have junk bonds breaking down as credit spreads break out? Will we see yields continue to decline? Will we see recession risks increasing? What are all the variables that we're going to be seeing that will feed this to become a bigger and bigger market correction? Nonetheless, I think that's a logical target. On page 6, I put that red band. And you can see that 5,000 to 5,200 level was where we saw key lows coming in around April and August of last year. And so if we do have this follow through, that would be a logical kind of support line where we'll be looking for short-term lows. Finally, I wanted to move on to page 7, and I wanted to look at the VIX, the volatility index. And while we saw a spike here up to the 25 level driven by this selling, we still haven't really seen a capitulating vol spike. Like if you look back to December or August of last year, we had jumps to 28 and 38 on the upside of the VIX, which were these just extraordinary rips, which was like the market just puking in a bucket. And those are typically associated with short-term swing lows. And we still haven't really seen that kind of capitulating blowout of the VIX. If we saw something 30 plus on the upside while the market's heading down, that would also be a really interesting indicator that may mark at least a tradable short-term swing low. All right, Eric, let's move on to that dollar.
Well, after spending weeks consolidating between 103 and 104 on the Dixie with no clear indication as to which way the market was going to go next, like I said last week, you can always count on President Trump to be the bull in the china shop, so to speak. After President Trump's tariff announcement, we got a really, really clear signal that the next leg on the dollar will be lower, with the Dixie trading on a 101 handle at the time of recording. I think we're probably headed toward a retest of the bottom of the intermediate term trading range around 100 on the Dixie. But this could easily retrace to the upside if other countries are quick to come back to the negotiating table and reverse some of Wednesday's tariff actions.
The negative reaction on the dollar to the tariff news has really resumed the sell cycle. With the consolidation that we had for several weeks, we currently have downside measured moves that are easily targeting the lows from last quarter, would be targeting the lows from the summer of last year down along the 100 level on the dollar index. Now, Eric, let's touch on crude oil.
After seeing a 72 handle this week in response to President Trump's very, very strong rhetoric about an invasion on Iran, WTI is back down to just above 69 at recording time, and it looks to be headed lower. The risk of further upside will be dependent on where this escalation with Iran goes from here. It appears that the Gulf states making it clear that they will not allow their air bases or airspace to be used to stage an attack on Iran, that appears to have put a damper on this rally, at least for now. But at the same time, the U.S. is moving a whole lot of warplanes and other assets to Diego Garcia. That's the island base, which would be their strike base if they're not allowed to use the Gulf states' bases in order to lodge an assault on Iran.
So, Eric, the way I look at this is that after such a big round of selling through January and February, crude oil was incredibly oversold and was due for a bounce. And we were targeting that $72, $73 area as the upper range of what was the trade range established throughout the fourth quarter of last year. Now that we've seen the crude oil reverse here, the big question will be, will it only just trade back down to the bottom end of its ranges to really solidify a trade range? Or are we still going to see another round of selling where if we see broader market concerns and recession risks that could send oil for a temporary dip down to the low 60s? One way or another, there is still a primary downtrend. There's a chance that we're seeing a basing formation, but there is simply nothing bullish on the short term on these charts. And so we're taking a very neutral stance here on crude. So, Eric, let's move on to gold here because gold's been on a rip. What are you thinking here?
Well, gold predictably spiked up higher and hit a new all-time high on the tariff announcement, but that move was very short-lived. The last 2 weeks have seen a massive move up on the gold price, and I think a lot of that move up has been brought about by the market buying the rumor of a major tariff campaign by President Trump. You've seen it all over the news. April 2nd is the day to watch out for. Tariffs are coming. Well, now that it's happened, it's probably time for the market to do what markets do, which is sell the news and retrace some of the last 2 weeks' speculative gains.
Well, Eric, I had an upside target of about 3,200 on gold, which has now been fulfilled. So with this bearish engulfing candle coming in here on gold, it's plausible that we're going to see a little bit of profit taking. Now, gold has been in the most pronounced bull market. It is still definitively a bull market. It's a primary trend. So it's not really about panic selling or something because of one reversal candle, but it is very typical after such a bull advance that it gives back $100 or $200 just in a consolidation that can take several weeks. It's not going to be a shocker if gold makes it all the way back to 3,000 on the short term, but I would view that as initially as a support line that could likely be bought on dip. And so we're going to maintain a pretty bullish stance on gold with the idea that on the very short term, it is likely to be consolidating into the next buying opportunity. Finally, Eric, let's touch on uranium from a technical perspective.
Well, Patrick, while I remain uber bullish long term, the fact of the matter is that uranium and uranium miners are in a downtrend, and the weakening of the broader market is likely to deepen the sell-off in uranium. Now, of course, if the broader market were to suddenly turn around on new news flow, it does look, as you've said, Patrick, that we're starting to see signs of exhaustion in the selling in the uranium market. So I do think it's ready to turn around, but not until the broader stock market bottoms, and it looks to me like we're still headed lower. So I'll be watching what the S&P does as far as when it might be time to really start buying more uranium. But I think the time to do that is when the broader market bottoms. Of course, is it possible that the broader market already bottomed? Anything's always possible, but I think it would take some news flow to get us there from here. And the more likely event that we head lower on the S&P, I think we're headed lower on uranium and uranium mining shares as well. Bottom line, uranium mining shares are a bargain at these prices, but I think that bargain's going to get better at lower prices before those prices go higher.
Well, exactly, Eric. On page 11, I have that Sprott Physical Uranium Trust. And while it's really stopped going down for a while, it really isn't going up either. We remain below the 50-day moving average and overall consolidating in a sideways pattern. It's a period where we may see some quiet accumulation, but clearly no bullish catalyst has emerged here that has started a new bull trend. We'll be looking for signs of breakouts above $22, $23 in order for us to see some sort of bullish breakout that would make us pay attention. But right now, I think we're going to be in a trade range purgatory for a little bit longer. Finally, Eric, I just wanted to touch on two charts. On page 11, I have the SOFR futures. Particularly, I wanted to focus on the December 2025 contract. And so the short-term interest rates started back in February pricing in the chance of more rate cuts by the end of the year. And it was a breakout after spending almost 4 or 5 months in a pretty deep consolidation. At this stage, this looks like a pretty clear breakout in the SOFR futures. And as recession risks increase and the Fed having to be more accommodative, it's entirely plausible that we can have an advance back to prices that we saw both in 2024 and 2023 up in the 97 level, which is yields by year end somewhere around 3%. And on page 13, I have that long bond, the 30-year bond futures. And they have also had a very, very ugly 3-4 month period through October all the way into January. But we've seen them starting to behave very well. Now, if you go back through the year of 2022, even into 2023, was a period where there was a huge bond bear market and you saw stocks and bonds declining together. But what we're now seeing is a characteristic where bonds once again are behaving much more like a safe haven. And while the stock markets and risk assets are under pressure, these treasury bonds are actually getting bid. And so we're seeing some good price action that may result in bonds moving higher from here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.